All right, so this is a basic overview of tax exemptions and lowering your taxes. Now, this is non-exhaustive. There's other things that I won't really mention or go into detail about, such as like if you gamble for a living, you can technically deduct your gambling losses as the cost of doing business. But as a general rule of thumb, the cost of doing business, business expenses, debt, and taxes, almost everything paid to someone else or given to someone else in the course of doing business or financing expenses for productive or wealth growth, dependent expenses or asset growth or servicing debt is deductible. So first we have business. Business expenses, profit and loss, you're going to itemize on 1040 Schedule C, which is the profit and loss from business. And you should honestly know this if you are a small business owner. But if you're a contractor or self-employed or other things like that, you can go ahead and use a Form 2106, which is employee business expenses, where you can deduct mileage, vehicle maintenance, supplies, equipment, personal tools, and just about everything except for meals that you eat, because that's kind of like a personal thing. And if you could deduct everything, like people would be going out to expensive restaurants all the time and then like not paying taxes on it. But basically, Form 2106 allows you to take the standard mileage deduction or take other deductions for vehicle depreciation, maintenance, fuel expenses, and other things. Now, with any deductions, you want to figure out whether or not the deductions that you itemize are going to be greater than the standard deduction that you can take when you're filling out your taxes, which I think is like $1,300 something for an individual and almost double that for a married couple filing jointly. Now, there's going to be farming. If you are engaged in farming, you will have to learn what a 1040 Schedule F is, but you can deduct almost every single cost of acquisition of things, acquisition of farm animals, seeds, other materials and stuff like that, chemicals, and gasoline for operating tractors or trucks and other things. And additionally, you can look into on a state and local level what ag exemptions exist, such as sales tax exemptions and other things on things purchased in the course of doing business in agriculture or running a farm. Now, for personal purposes, there's the 1040 Schedule A. Now, the 1040 Schedule A allows you to deduct mortgage interest, sometimes property tax, other expenses and stuff, and charitable contributions, in addition to like theft and loss and other things that you had to pay for out of pocket as a consequence of stuff out of your control that were regular expenses that like damaged assets that you owned and stuff like that. Now, real estate, you're going to have the form, this is for like investment properties and other things like that. You're going to have the Form 4562, which you can deduct the cost of improvements, capital expenditures, depreciation, and amortization. And you're also going to have to file a 1040 Schedule E, which is for income, rental income, expenses, and depreciation. Another thing that I didn't write on here is if you sell an investment property to buy a property of equal or greater value, you can do a 1031 exchange and pay no capital gains tax on putting that money that you made from the sale of an investment property into another investment property. You can't do this for your personal properties or anything like that, although I'm sure that there's people that have tried. And a owner-occupied sort of rental unit, like say you have a duplex or other things like that, is subject to different rules and limitations on what you can actually deduct because it's considered partially a personal residence. So, stocks. You can deduct up to $3,000 in realized losses. And as an example, you bought Rivian at $100 and you sold it at $50. That is a realized loss. You just lost all the money that you put in. And if you have, depending on how much you put in, you can write off that loss on your taxes. And that might be good because you might have realized a gain of $3,000 in something else that might have appreciated even more. And you sell a little bit, you're kind of even, but you don't pay taxes because the deduction that you get from deducting your 3K loss in whatever the stock happened to be. And if you lost all of your money, like your life savings, you can go ahead and carry over the extra losses over to the next year, basically in perpetuity until your loss has been fully deducted from your taxes. But you can only do it in $3,000 increments at a time every year. They might change it going forward, but who knows? So the other thing is you can use tax-deferred and tax-advantaged accounts. These accounts allow you to deduct money from your income and basically reduce what you pay taxes on overall, but allow you to use that money for qualified expenses and other things. Now, the examples are a 529 plan, which is for education expenses, and you can use this for literally private school tuition and other things like that. You can use it for college, you can use it for trade school, books, and related expenses, and then you have a health savings account and a flexible spending account, which are basically to kind of cover health costs outside of what insurance covers and outside of the premiums that you pay for insurance. So any out-of-pocket costs or co-pays can kind of be subsumed under these two things. The other thing you can do is for retirement accounts, all of these things are tax deferred, where you can reduce the amount of taxes that you pay in a year by contributing to any of these accounts. So first you have the 401k, your contribution is deducted from your taxable income, plus you get that little added match from your employer. None of it's taxed until you start withdrawing it at retirement age. The same applies to the 403b and 457 plans. And the traditional IRA, which is outside of your employer, it's basically same rules as the 401k. You only pay taxes upon withdrawal, but there's a trick that you can do where you can do what's called a backdoor Roth conversion, where you can convert your traditional IRA into a Roth IRA, pay taxes right then on the gain that you made inside of the account, but then convert it over to a Roth account where it can continue to grow and basically be tax-free upon retirement. You don't pay any taxes on any of the gains inside of a Roth account unless you take money out before, I think, the age of 59 and a half, in which case you pay a 10% penalty in addition to it being taxed as ordinary income. But you can let it basically grow tax-free until you have to withdraw it, and then it's basically free money. The other things that I'm going to cover real quick, just as a quick overview, is sales tax exemptions. You have ag exemptions, you have nonprofit exemptions, and a lot of states offer sales tax exemptions to disabled veterans and other groups of people. You have to look into your individual state law to figure out what sales tax exemptions are offered by your state tax authority. And additionally, you have to do the same thing for property tax exemptions, although normally it applies to nonprofits and disabled veterans. And some states just altogether don't have any property tax. To go back to that, some states don't have sales tax. And to go back even further, some states don't even have a state income tax. A couple things that I didn't write down is that there's certain things that you can invest in and certain ways that capital gains are measured. There's certain instruments that you don't pay any state or even federal income tax on the gains from them, such as tax-free, like municipal bonds and other things like that. And additionally, capital gains for dividend income is measured more so based on your actual income. Now, I haven't seen anyone use it yet exactly, and I haven't used it for myself, but effectively on dividend income, other than income derived from things like REITs and BDCs, certain trusts, closed-end funds, and other things that are supposed to give 90% of their profits back to investors in the form of dividends. Those people, you're going to be taxed. They're going to be taxed as ordinary income, depending on your tax bracket and stuff. But qualified dividends and return of capital payments from specific stocks and instruments are taxed slightly differently in K1 forms for like master limited partnerships and just limited partnerships in general and other things like that. Generally, you realize the losses, the business expenses of the company, and you realize the profits, and the losses are deducted from the profits, and it's entirely possible to pay no taxes on them. Additionally, I haven't covered estate taxes and other things, but there's ways to get around estate taxes that a lot of people employ, but normally estate tax only applies to really wealthy people. So if you're not really wealthy, you don't really have to worry about that. Plus, you can generally do little things where you structure payments and giving things to your heirs or what's the word for it? Whoever your dependents are, you can give things, or your spouse, you can transfer assets over to your dependents or the people that are the beneficiaries of your estate before you end up dying. And you can generally give it as gifts, or you can give assets under a nominal reported value of one thing, but it actually has a market value of something else. I know Donald Trump's father, Fred Trump, did this tricky sort of shit when he was handing over his real estate business over to his children and to Donald. Not that I'm talking crap about Donald Trump. I actually really like him because he's an asshole, and I appreciate that. I like the New York state of mind. They're all major, bold assholes about everything. But what he did was he sold parts of his business for way under value to his children so that it could be registered as a business transaction or a sale rather than something that would be broken apart by a what's the word for it? By probate, or by whoever's the executor of the will, rather than having to go through that and having to pay estate tax and wealth tax inside of New York State. But there's ways to get around it through gifts and gradually handing your assets over before you die. And in addition to that, you can generally write off a lot of charitable contributions to 501c and other charitable organizations like your church and other things like that, or just general charities. You can write off things that you drop off as donations to Goodwill and to thrift stores and other things like that. There's a lot of things that you can write off. But anyway, that's just kind of a basic overview of tax exemptions and generally lowering your taxes. Now, I've talked about the Form 2106 before because I made a video about DoorDash. This is where you can take the standard mileage deduction and basically reduce your tax basis for having to pay self-employment tax, which is a 15% tacked on to your already, like, whatever your tax bracket happens to be from the income that you make, because you're making 1099 income rather than W-2 income. You're a contractor. But Form 2106 can apply to really any contracting job, including if you're driving your truck for business to go to a site where you're building a fence for somebody, or you're doing landscaping or contract work or anything else like that. But if you're operating just a business in general, Form 1040 Schedule C is going to be where you actually keep track of your receipts and itemize the cost of doing business and what it cost you in materials and labor and everything else like that versus what you actually gained in money. Because if not, it's just gonna, if you didn't have the option of deductions, basically the government would just look at your gross income and assign you a tax bracket based on your gross income. So with all these things, you have to figure out whether or not these expenses are less, or like these things that you can deduct are less or greater than what the standard individual deduction is, or what your deduction is for having children. If you can claim more based on the standard deductions, go ahead and do that. Like if you can claim more itemizing everything, then go ahead and do that. But doing all these things, you'll generally pay less taxes. And as another rule of thumb, everything under the table or in-kind payments for things can't be taxed, because there's really no way of tracking it until it enters into official reported institutions and other things like that. I'm not advocating storing money under your mattress, but there's other ways that you can get around having to meet the reporting requirements to the IRS and to other federal authorities with your money. Anyway, that's all. Y'all have a good day.